So we are done with the additional information. We are done with the additional information. Okay. So let's come to liabilities. Liabilities. Liabilities, we have sundry creditors. You bring the original value. What is the original value? Sundry creditors. The original value was what? Sundry creditors. What was the original value?
412,000.
412,000. 412,000. But out of this amount, we have settled the Banda Limited, which is 240,000, isn't it? Included in that particular amount is 240,000 owing to Banda. And we have converted 132 to equity shares, and we have given him equipment in return for that particular, the remaining balance, which is 108,000. So we have settled 240,000 out of the 412,000. So the remaining one will be the 412 minus 240,000. Okay. Let's come to another issue. Another issue is about reducing the equity shares of the company. So what is the new value of the equity shares of the company now? In the new company, it's 80,000, isn't it?
Yes.
So we are making a gain of what? 20,000. Where would that gain go? The last time we said that when the income side of the capital reduction is more than the expenses side, the difference will be sent to capital surplus, isn't it? So the gain will be added to the capital surplus. The gain will be added to the capital surplus, which is 20,000. So let's add all. Let's add all. What is, if you put all the equity values together, what are you getting? If you put all the equity values together, what are you getting? 80,000 plus 48,000 plus 132 plus 140. We are getting 400,000. 400,000. What will be for the capital surplus account? Capital surplus will be 6. It will be 48,000. So we are having, if we put that together, we are having 448,000. Then we add the liability element, 412,000 minus 240,000. That will give us 172,000. 172,000. Also 2,000. Yes. Plus. Yes. Okay. That will give us this one. Okay. So this is all that they are expecting us to. If the question didn't ask you to find or to draw capital reduction accounts, don't draw it. Just ask if you want to do that as a working, that will help you to maybe get whatever you want to get. You can do it. But if you can also maybe put the expenses at one side, the income at one side, then you subtract it where the balance will go. If it will be a good deal or it will be a capital surplus, then you send it there too. But the question didn't ask you to do any of the accounts. Don't do it. You can just do working somewhere, or you can even do it on your paper. You can even do it on your answer booklet. Then you get your figures. Or another way of doing the workings is that just bring the original figures. Like if you're referring a statement of financial position, just bring the original figures, equipment. Then you bring it like the way we do consolidation. Bring the original figures, any adjustment that you are going to do, net it off. You bring the 468, you are going to write 108,000 as for trade payables. Just bring it, subtract it over here. Bring your bank, you do your adjustment. You can just do the adjustment in the statement of financial position. Nobody is going to do anything to you. The stated capital figure, you can also do it like this and do your working. The one that will add, you add. The one that will reduce, you subtract. Capital surplus, you do the same thing. Sundry creditor, you do the same thing. And you are good to go. You are using time. You are using time. So this is basically what they're asking us to do. Let's look at the next question. The next question, which will be our last question. The next question, which will be our last question, which will be question 4. Question 4. Okay. Let's look at the question 4. So, okay, someone should read the question 4 for us. We have 2 linos here. So which of them? The bigger linos.
Not
One
the
is
other one.
one is having the video on, not your own.
Okay. All right. So are we okay with the liquidation options? The first thing is, if you are liquidating, how much are you going to be receiving from the sale of your asset? Get it. Okay, out of this amount, how am I going to distribute this amount? You distribute it based on criteria. Those debts that are secured against the asset, the proceeds that you have gotten from that asset, use it to settle off part of the debt. If the proceeds can settle all. Do you have any preferential debts? GRA, SNIT, and those things, settle them. Do you have any debts which is secure on a floating charge? You do it. If you have a liquidation cost, you also settle that ones. After settling this, the remaining proceeds left should be distributed among those debts are not secure, those are not preferential. You just distribute it among them based on the total amount that you are owing them. You do it in that proportion. You do it in that proportion. That is basically about the liquidation. The liquidation will always come with either you liquidate or you reorganize. So you do the two and tell the company what they should do. If they should liquidate or they should reorganize, you advise them. That is a scheme. That is a scheme that they are talking about. That is a scheme that they are talking about. Let's look at question 4. Someone should help us read the question 4. Someone should help us read the question 4. Question 4. Who is reading for us? Okay.
I'm reading.
Okay.
Chew Factory Limited has incurred losses for many years. However, the company is developing a new product which is expected to generate profits of 100,000 per annum in anticipation of an immediate capital injection of 2 million Ghana cedis. The company's statement of financial position as at 31st December 2010 is as follows. Assets, PPE, 3,250,000. Inventories, 1 million. Account receivables, 500,000. Total, 4,750,000. Liabilities and equity. Ordinary share capital at 1 cedi, 2 million. 10% preference shares, 750,000. 15% debentures unsecured, 1 million. Accounts payables, 1 million. Bank overdraft, 750,000. Income surplus, a deficit of 750,000. Total, 4,750,000. The bank overdraft is secured against the property, plant, and equipment. In the event of a forced sale, the assets would probably raise the following amounts. PPE,
Okay.
1.
So in the event of a forced sale, that is liquidating, isn't it?
Okay.
Okay, in the event of the forced sale is the liquidation. Okay, so let me just make it liquidation options so that we go with the liquidation first before we liquidation options. So the proceeds, what will be the proceeds from the assets? The first one is what? The first asset
PP.
is how much? PP
1.5 million.
1.5 million. So we put three zeros at the top. And that would be 1,000.
No. Okay, then that would be 1,005. Yes.
The next one is
Inventories.
inventory.
400.
Which one again?
This it seems your voice is low.
Okay, inventory is 400. Which one again?
Accounts receivables.
Accounts receivables. Account receivables. How much?
350.
350. Okay. So what will be the total process?
$2,250.
Okay. So with this one, then you make the distribution now. So the distribution, we read the question and look at the order that distribution will be made. Okay. Let's move on.
The directors.
Okay, the bank overdraft is secured against the property, plant, and equipment. So what is the bank overdraft figure? 750,000. And what is the property, plant, and equipment is 3 So a portion of it was secured against the bank overdraft. So bank overdraft is 750. How much are we realizing from the PPE? We are realizing more than that, isn't it?
Okay.
So we can pay all the bank overdrafts. We can pay all the bank overdrafts, which is 750. We can pay all of them. We can pay all of them. Are we okay? Okay. Let's move on to the next one.
The directors are therefore proposing a capital reorganization of the company on the following basis.
Okay. Let's move on.
The ordinary share capital should be written down to 200,000 shares of 1 cedi each.
Okay. So right now, if we are reducing it down to 200,000 shares at 1 cedi, it means that the new value will now be 200,000 now, isn't it?
Okay.
What is the original value?
2 million.
It is 2 million. So they are giving up how much? That would be 1.8 million. It's too much. Hey. So this is the price that you pay for your ordinary shareholder. The ordinary share capital should be written down to 200,000 ordinary shares of 1 cedi each. It's too much. Let's move on.
Okay.
Let's move. I want us to get the information about the liquidation first before we come to the statement of financial position.
Okay.
All right.
The 10% preference shares are to be converted into 150,000 ordinary shares valued at 1 cedi per share.
So their new value will be 150 now. What was the old value? The old value was 750, isn't it?
Yes.
So they are also giving up 600,000. Both are gains. Okay. That will be the capital. The restructure will be very interesting. Let's move on.
650,000 of the 15% debenture should be converted into ordinary shares at 1 cedi per share, and the remainder to be converted into 350,000 10% debentures.
So the debenture interest is the debenture is 1 million, and they are converting 650 to ordinary shares, and now the remaining 350 to 10% debentures. There is no gain, there is no loss. We are just converting all the amount to them. Okay.
Trade creditors to accept a moratorium of 6 months in payment of amounts currently due them. New supplies will be paid for on delivery.
So the trade creditors, now what we are saying is that we are pleading with you for that we pay you in 6 months time. But any supplies that will come right now will be paid on what? Delivery. We pay you as soon as you bring the goods. Okay. Let's move on.
A 2-for-1 rights issue will be made at a price of 1 cedi per share for cash after the above conversions.
Okay. So we have to look at the convention before we look at the portion that will be issued. So after converting all that you convert to equity shares, then you now issue a right issue. You now give them a right issue based on the new structure of the equity share. So we look at that one later. Let's move on.
Property, plants, and equipment are to be revalued at 2.250 million. Inventories at 600,000 and accounts receivables at 450,000.
Okay, these items are for what?
Reconstruction.
Reconstruction. So you can see that the reconstruction items are too much. So it is necessary for us to draw the what? The capital reduction account, isn't it? It is too much. We can't do it from the head, so you have to draw it. Let's move on. Let's look at
The
what
accumulated losses are to be written off.
Okay.
The corporate tax rate is 25%.
Okay.
Liquidation expenses will amount to 10,000.
Okay. So what will happen is that we have to go and pay the liquidation first. Liquidation expenses will also be part of the distributions. So we have liquidation expenses. Liquidation expenses is what? It's 10,000 or 100,000.
10,000.
So it will be 10. Okay.
So let's write 10. Yes.
Okay. Okay, let's move on. So what is the requirements now?
A, prepare a statement of financial position after reconstruction on the assumption that the capital injection takes place. B, compute the expected profits after tax and the earnings per share after the reconstruction. C, prepare a statement of distribution if the company were liquidated now.
So the liquidation that we are doing is C, isn't it?
Yes.
Okay, so the first one should be the capital reduction part. So prepare statement of financial position after reconstruction on the assumption that the capital injection takes place. Okay, so the first part is that let's draw. Yeah, I'm fine. Let's draw the capital reduction account. So I'll name this one C, isn't it? So that I'll name this one C so that it will not be something difficult for us. So let me name this one C. And I'll count to, let's count to A. A is the statement of financial position. So statement of financial position, assets, you put the date there. So before we can draw the statement of financial position, we need to draw the capital reduction account, isn't it? To know what is happening there. Capital reduction. Capital reduction accounts. So we are going to put the currency sign here. 2 zeros. And put the 2 zeros. Okay. So this one we start with the asset first. We start with the asset first. Okay, let's go to the question. What are the new value of the assets now? Property, plant, and equipment is what?
2,250.
Okay, so those will be the new value of the asset in the new company. So PPE will be 2,250, isn't it?
Yes.
Okay, so the question is, what was the original value? What was the original value? What was the original value?
3,250.
Is it a reduction or an increase?
Reduction.
So that will go to debit or credit side of the capital reduction account. Is it going to be a debit or credit?
Credit.
We have
Debit.
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 Okay.
Debit.
So the
Reduction.
amount is what?
2,250.
No, 2,250 is the new value now. But
Yes.
the old value
And
was,
the difference.
yes.
The old value was 3,250.
Okay, so what is that? We are losing by what?
1,000.
1,000.
Okay. So the asset that we have, 2,250, we are now valuing it. It means that we are losing. Okay. What is the next asset? The next asset is inventories. Inventories. And the new value is now it's not the breakout value, it's not a forced sale value, it's the real value. The forced sale is when we want to liquidate. We don't want to continue the business. Inventory will now be 600,000. Inventory will now be 600,000. So what was the original value? What was the
1
original?
million.
1 million. So that one to a gain or loss?
A loss.
A loss of how much?
400,000.
Okay. So that will be 1,000 minus 600, isn't it? Okay. And that will give us a loss of 400. Okay. The next one is what? The next asset is what?
Account receivables.
Accounts receivable. You see, don't go and say you are arranging this in non-current assets and current asset. No, the question, the format, sometimes we answer the question based on how the statement is given to us in the exam. The examiner gave you total assets, just assets. Don't say you are going to separate it on non-current asset and current asset. You are using time. You are wasting your own time. Just do it the way it was given to you and go. All right. The new value now is what?
450.
450. What was the old value?
500.
500. So we are making, there's a loss of what?
50.
Which we can call bad debts. You can name it bad debts, which is 50. You should have collected 500 from people. You are now collecting what? 450. It means that 50 of the debts has gone bad. Okay. Let's look at the cash side. I hope we are having overdraft in the question, isn't it? In the
Yes.
question, we are having overdraft of what? 750. They are saying that you should prepare this one with the assumption that the capital injection has been made, isn't it?
Okay.
Okay. What would be the immediate capital injection that they are asking the shareholders to make? At the top of the question, they are to
Written down.
at the top of the shoe factory, before you have the statement of financial position.
2 million.
2 million, isn't it? Okay.
Yes.
These 2 million, they are going to pay by cash or bank, isn't it? So the capital injection means that we are going to issue additional shares out and they are going to pay for it, which is 2 million. So we are going to receive a cash of 2 million into our bank accounts. But already we are owing the bank how much? We are owing the bank how much? We are owing the bank 750. So what will be the amount left? What will be the amount that will be left in our bank account if we receive the 2 million? It will be 2 million, 2,000 minus 750. How much will be left?
1,250.
1,250. I hope we are okay with that one. That side. 1,250. We are done with the assets. Let's count to equity and liability.
Hello.
Yeah,
Is it 750,000 or 750 million?
we are keeping 3 zeros.
Okay.
Okay. Are you okay? Okay. Equity and liabilities. Okay. So right now we can focus on our capital reduction now. So let's take additional information again. The directors are therefore proposing a capital reorganization of the company on the following basis. Okay. On the following basis. So we can now have our stated capital now. So the stated capital, what will happen is that start with the original value. What was the original value in the statement of financial position? The ordinary shares, what was the original value?
2 million, that's 2,000.
2,000. Okay, so we can now take the additional information relating to ordinary shares capital now. So the first one is what?
Ordinary share capital should be written down to 200,000 shares of 1 CD.
So what will be the new value now?
200,000.
What was the original value?
2 million.
So it means that we should have paid them how much? We should have paid them 2 million, isn't it?
Okay.
But they have now accepted to. They have now accepted to. We should have paid them. We should have paid them 2 million, but they have now accepted to receive what? 200,000. It means that they are giving up what? 1.8 million, which will be a gain or loss. To the company, is it a gain or loss?
It's a gain.
It's a gain. So ordinary shares. So we have ordinary shares. Ordinary shares to be a gain of what? 1,800, isn't it? All right. So what will happen? It means that we need to write down the 2,000 to 200, isn't it? We need to write down the 2,000, which was the original value, now to what? 200. How do we do that? We subtract 1,008 from it. So we subtract 1,008 from the original value to make it now 200. That is a new value now, 200. Let's move on. What is the next one?
The 10% preference shares are to be converted into 250,000 ordinary shares valued at 1 CD per share.
So the new value of the preference shares will now be 150,000, isn't it? What was the original value?
750,000.
So they are giving up 600,000, isn't it? A gain or loss to the company?
A gain.
A gain of 600,000. So you come here, we have preference shares. Preference shares to be 600. So what will happen? Our equity shares will increase by what? 150, isn't it? Because they are converting their preference shares to equity shares. So we now have 150 as an increment to our equity shares. Let's move on. The next one is what?
650,000 or 15% debenture should be converted into ordinary shares at 1 CD per share, and the remainder to be converted into 350,000 10% debenture.
So in all that would be 1 million. So let's go and ask ourselves, what was the debenture? The debenture is still what? 1 million. So it means that they are not giving up any value. We are not making any gain or loss, but just that 650 of the debenture will be converted to equity shares. So what will happen to the equity shares? Is it going to increase? So we add 650, isn't it? So we add 650. Let's move on. So if you are going to the debenture side, which is liability, our debenture will now be 10% debenture at 350, isn't it? All right, let's move on.
the trade creditors to accept a moratorium of 6 months in payment of amount currently due them. New supplies will be paid up for on delivery.
Okay, so creditors, they are not accepting to give out any value. They are not accepting to forget about any amount of their debt. They are just saying that, okay, since you are trading with us, that we will pay you in 6 months, okay, we wait for you, come and pay. So there's nothing relating to that. You carry their original value to the new company now. Okay, what is the next one?
A 2-for-1 rights issue will be made at the price of 1 cedi per share for cash after the above conversions.
So the above conversions that they are talking about is that after you have written down your ordinary shares to 200,000, you have converted the preference shares to 150, you have issued 650 ordinary shares to them. That is the above conversions that they are talking about. So if we have done those above conversions, how many of the equity shares are we going to have now? We are going to have 200 for the ordinary shares, 150, and the additional 650, isn't it? Is that it?
Yes.
Okay. So the total number of equity shares will now be what?
1,000.
1,000. So you are saying that 2-for-1. 2-for-1 means bring one of your shares and take one new. Bring one old of your shares and take one new. So how many shares are they going to have now if it should be for 2-for-1?
2-for-1.
Yes. The total shares is 1,000 and we are doing 2-for-1.
Okay. It should be 500.
No. Bring one of your existing shares and take two.
Okay, then it should be 2 million.
It will be 2 million, which is 2,000, isn't it?
2,000.
Valued at how much?
1 cedi per share.
So the total amount that we are going to be receiving will be how much?
2,000.
2,000. It means that our equity shares will now increase by what? 2,000. This will be done by what?
Cash.
Okay. So we have 2,000. So what will happen to the cash? Our cash will still increase by what? Our cash will also increase by 2,000 again. Okay. So it means that this place should have been 3,250. Okay, let's move on. Let me just assume maybe we are going to have liquidation cost or reorganization cost. Reorganization cost. That's so that we subtract it from the cash or we pay by the cash. Let's move on. Okay.
Hello,
Let's
sir.
Yeah.
So please, is this 2,000 different from the initial capital injection we were told they will be made?
Yeah, the capital injection is relating to only the ordinary shareholders.
Okay.
But for this right issue, since we have converted some of the preference shares and also some of the debenture holders, they all take part in the right issue. But for the 200, the 2,000, which is the 2 million from the beginning, that injection will be done purely by the ordinary shareholders.
Okay.
But the right issue will now be made available for all those who are who are the ordinary shareholders now, which is the debenture holders who have converted to preference ordinary shareholders, the preference shareholders who have converted to the ordinary shareholders. So don't go, it's just a coincidence that this figure is the same as the capital injection.
Okay.
Okay. All right.
Thank you.
Okay, let's move on. So the property, plant and equipment are now we have done that already, isn't it? The accumulated losses are to be written what? Off. So what is accumulated losses? Is the losses on the what? On the income surplus account. How much is that?
750,000.
So which side is it going to be? Debit or credit for capital reduction?
Debit.
The debit side.
Debit side. So income surplus. Income surplus of what? 750. Okay. So since we are assuming that this one, our equity shares will increase by 2,000 two times, isn't it? One is the capital injection, one is the right issue. Okay. So let's come here and add. Let's add the two sides. Which of them is higher? Which of them is higher? The credit side is how much? It's 2,400, isn't it?
1,400.
Okay. The debit side is how much? It's 2,200.
1,200.
So which side is higher? The credit side.
The credit side.
By how much?
200.
So the 200, how are we going to name it? Goodwill or capital surplus?
Capital surplus.
So it will be capital surplus because it is an income. It will be capital surplus. Okay, that will be 200. So we have 2,400 here and also 2,400 here. This our capital surplus will be sent to our statement of financial what? Position. So you have capital surplus of 200. Okay. Okay. So I'm sure that is the end of the additional information, isn't it? Okay, that is the end of the additional information. So what we'll have to do now is that let's bring our liabilities now. Our liabilities now. So the liabilities, which of the liabilities are we going to have now? Which of the liabilities are we going to have now?
The 10% debenture.
Which is how much?
The new one.
Okay.
350,000.
Okay, 10% debenture. Debentures, which will be 350,000. Which one again?
Accounts payable.
Okay, accounts payables.
1,000.
Accounts payables. 1,000, right? There won't
Yes,
be bank.
1,000.
There won't be bank
1,000.
overdraft. There won't be bank overdraft because we have done some transactions through the bank, which we now have what a debit what bank balance. So it will now be an asset, not a liability again. Are we okay? All right. So let's come here. Let's put our these figures together. What will be our total value of the assets? What will be the total value of the assets? Total value of the assets will be total value of the assets will be 6,550. Let's count to our equity shares. What will be the total value of the equity shares now? It will be 200 plus 150 plus 650 plus 4,000. I'm getting 5,000. Am I correct? Am I correct? Who is also adding? We have 2,000 minus 1,008 plus 150 plus 650 plus 2,000 plus 2,000. How much are we getting? You can also get the 5,000. You can also get a 5,000.
Yes, it's 5,000.
Okay. So let's count to our liabilities now. So 5,200 plus 350 plus 1,000. What will be the total figure? Okay, we have
6,550.
Okay. So This one, some people, they will take their time and be drawing equity on equity shares account. Don't go and waste your time. Just put the original value there. If you are doing a reduction, what should I do to reduce it to the amount that they are talking about now? Then you have to subtract the amount. If there's any conversion, add it. If something is going to reduce, put the original value there and reduce it. That is all. Don't go and be doing, unless the question asks you to prepare equity or ordinary shares accounts or preference shares account or bank accounts. That is where you are going to open bank accounts. But you can also do that as an workings, but it's not required. It's not a requirement. You are not going to take any marks for it. All right. Even if you open it like that, they are going to mark the ticks. You see the stated capital account here. You see the 2,000 over here. They are going to mark it. The 1,000 is they are going to mark all of them one by one. They are going to mark all of them one by one. Even if you should open the account, they will still mark it one by one. But the account, you know that you are using time. So someone can also decide to do the capital reduction account like this. Instead of the person doing the debit and credit accounts, the person can just do it like the vertical format, where the person will put all the total income, which is the 2,400, and now subtract the PP, the inventories, the bad debt, the income surplus, and those things from it. It's the same thing. You are going to get the same answer at the end. There's no problem with that. Anyhow you want to do it and get your answer. Nobody is saying something.
Hello, sir.
Yeah,
How are you?
I'm good, and you?
I'm also doing well. We are coming to sack you. Your time is up.
The
Yes, so-
tax.
yes.
Oh, Charlie, it's 12 If you can give us 10 minutes so that we finish everything.
No, we won't give you 10 minutes.
I spoke with David. He said that he will start like 12:10.
Okay, then that's fine.
Okay, all right. Thank you. All right.
Sir, please, the statement of financial position.
Okay.
Okay. I wanted you to scroll up so that
This side.
the bank.
Okay.
I don't understand why the 3,150.
Okay. We are going to make a right issue. Have you seen the right issue part?
Yes.
The right
The
issue.
2:1.
Yeah. So after the convention, we are going to have 1 million shares, which will be issued at 2-for-1. Bring one and take two. So the shares will not double to be 2,000. And this will be issued at 1 cedi, which is 2,000 or 2 million Ghana cedis. And this one, they are going to pay for it. So we assume that they are going to pay through bank or check. So that will be 2,000. The bank will increase by 2,000. The equity shares will increase by 2,000. And this one too, they are saying that if the shareholders are saying that we should reorganize, they should also make an immediate capital injection of what? 2 million. So the equity shareholders are going to pay for additional shares, which will be what? 2 million, which is also going to be through bank. So in all, you see that we have 2,000, which is 4,000. But in the question, there was a bank overdraft. The company is operating on a bank overdraft. So as soon as the 4,000 hits the bank account, the bank is automatically going to subtract the 750. So if you take 750 from the 4,000, you are going to have what? 3,250. Are you okay now?
Yes, please.
Okay, let's move on.
Thank you.
All right. So we are done with this part. We are done with the first one. Compute the expected profit after tax and the earnings per share after the reward construction. So let's look at the question, the B part after the reconstruction. So what are they saying? Which is expected to generate a profit of this one per annum in anticipation of immediate capital, this one. So what will be the profit per annum? What is the profit per annum? What will be the profit per annum? From the top.
400.
400,000. That would be the profit per annum, isn't it? Okay.
Mm.
But since they didn't say, the question is giving us the corporate tax rate. The assumption is that the 400,000 is profit before what? Tax. Is profit before what? Tax. So the 400,000 over there is profit before tax per annum. So if you want to know the profit after tax, what are we going to do? Okay, it's profit before interest and tax. Let me put it like that. The assumption is that the 400 per annual profit is profit before interest and what? Tax. So let's count to the distribution. The distribution, the profit after tax, and also the earnings per share. Profit after tax, also the earnings per share. So the first thing that we have to do is to know the profit before tax and interest. So profits before interest and tax is what? 400,000 every year, isn't it? It's 400,000 every year. All right. So what will happen? What will happen? After making the profit, we are going to pay interest. Are we going to pay any interest?
Yes, the debenture.
The debenture will now be 10% on which amount?
350.
350,000. So 0.1 times 350. That will give us how much?
35.
Okay, so you can say finance cost or interest. Just make it interest. So in the new scheme, the company will be paying interest of 10% on the new debentures now, which is 350. That will give us what? 35, isn't it? So what will be the profit before interest? Profit before tax, rather. Profit before is what?
365.
365. 365. Okay. 365. 365. So 365. So our income tax rate is what?
25%.
So we calculate 25% on what? On the profit before tax. Are we okay? And that will give us how much?
91.25.
Okay, 365 times 0.25. 91.25. 91.25. So what will be the profit after tax?
273.75.
273 point what?
75.
75. So this will be our profit for the year. This will be our profit after tax. Are we okay with that side? Profits after tax. So whenever there is a question like this, the profit given to you, unless the question says is profit after tax, assume that it's profit before interest and what? Tax. And the question will always give you the tax rates. And also in the new company now, you are going to, anytime you make profit, you pay interest to the debentures, which is a 10% on the 350,000. That's how we have that like that. Let's count to the earnings per share. How do we calculate earnings per share? Is profit attributable to what? Profit attributable to ordinary shares. So assuming the preference shares were not converted to equity shares, we find the preference dividend and subtract it from our profit after tax. But right now we don't have any preference shares again. So the profit, which is at 273.75, is now the profit attributable to the ordinary share holders. So profit after tax divided by number of ordinary shares. Number of ordinary shares. Number of ordinary shares. What is the number of ordinary shares now?
5,000.
Scroll up for us.
Someone is saying
5,000.
no, that is the
5,000.
value. That is the value. Okay. What is the number of ordinary shares now?
5,000.
5,000.
These are all at one city, isn't it?
Yes.
Yes.
Okay. So this will be the profit after tax This will now be 273 divided by 5,000, isn't it? 273 273.75. What is the answer?
0.05.
0.055.
0.0. Let's put it in the pesos. Let's put it in pesos.
Okay, so that will be 5, let's say 6 pesos.
5.5 pesos.
Okay, 5.5 pesos, isn't it?
5.5 pesos.
Okay, 5.5 pesos. So you know that this thing, any per share is calculated as any attributable to the ordinary shares divided by the weighted average number of what? Ordinary shares. But in this case, the question given to us, we cannot determine when these shares were issued and when these shares were issued. So we can't determine that. So we just take all the ordinary shares and make it the number of ordinary shares. That is it. So the next question is, compute the expected profit and any per share after the reconstruction. We are okay with that. Are we okay with the B part?
Yes.
Okay, if the company is to liquidate now, calculate the distribution. We started that liquidation 1, 2. We started that part 2. So let's just go and complete it. Okay. So in the question, do we have any other issue concerning who to pay first and who not to pay? Do you have any preferential debts? Do you have any debts on floating charge? The question didn't say anything like that, isn't it? Did the question say something like that?
No.
Nice. The 50% debenture is unsecured. So since it's unsecured, which is unsecured, what do we do? If you look at the distribution formats, do we have something to do with the unsecured? Let me go through it again. Okay, debt with carrying a floating charge. Are we there? Okay, then we don't have any floating. So what will happen? Unsecured creditors. If you still have balance, do you have balance?
Yes,
Do you have,
300.
okay. What will be the balance that we left? 2250. One is 750. One is 10. We are going to have 1490. 1490. Let's look at how this will be done. Let's look at how this will be done. So unsecured account payables. No, if we should do the distribution
Hello,
like that,
sir.
yeah.
Please, you need to continue next time. Okay.
Oh, okay.
The
Thank
tax
you.
people are
Okay.
so, okay.
All right.